Welcome to my channel. I'm Dr. Romano. Today's topic is going to be the future of investment banks and where do I see investment banks headed to. Most of my content is about trying to get investors to reanalyze their approach and where they invest their capital. Because I'm a doctor of hedge fund selection, I'm actually a doctor of finance, but my research is on hedge fund selection for a funds of funds. So I'm not here to put down anyone or any industry, but I'm here to help you analyze where the industry is going, where it needs to go, and where you need to put your capital. Because remember, we Americans, we worship big brands. And that's the problem. It's not the big brand that's safe. It's actually the little brands that manage your capital much more effective. So because I love history, I, of course, read a lot. And I mean, as a Ph.D., of course, I'm still reading. But I've always understood that nothing is always the same. And when we had the investment banks all merged together, there were only a handful left in the 1990s and 2000 to 2010. By 2010, it was the end of the investment banks moving upward. And by the 1980s, they realized that the only way for them to stay in business is to merge together, and that created the 1990s. So at that time, because they were no longer innovative, they were merging together to create a market share, a larger market share, and larger profits for their investors. That's what you should have been watching. And you should have been analyzing that, where was the future going? So now that you only had a handful of investment banks left by the end of the 1990s, you had a lot of people in the industry go off on their own and open their own investment company. And that paved the way for what you know to be a hedge fund. Hedge funds, all they are an investment company at a boutique level. And when I say boutique, they don't have hundreds of people running around and managing situations. There's just one person trading capital, and possibly there's another person connected to the company that's raising capital, etc. Now, there's a video about what is a hedge fund. You could watch that, but I'm not going to talk about what are hedge funds in this video. I'm focusing on the direction of the investment bank industry. All right, so the other question is, as an investor, why would you put your capital in a company that allows 20-year-olds to trade your capital? Do those 20-year-olds have a track record? What are the returns as the outcome of that situation? And so I have firsthand knowledge because I used to work for one of the top investment companies. I didn't just have any type of job. My job was very important, and the group that we worked in was very important. It was very new, and it was basically risk management separating themselves from the trading desks. And that became corporate risk management. In corporate risk management, the whole group, 90 of us, were doing our analyzation of the returns, the losses, etc. And each group did something different. And of course, it all led up to helping the chief financial officer know what the company is headed to, the losses of the company, etc. So that they could have their meetings with their board members, etc., and push the company towards a direction. My job, I worked on the trading floor for risk management, and my job was to scrub the data, meaning that the actual trading desk, the data, the returns, before the chief financial officer would look at that data. Because there had to be investigations as to why that trading desk was in red and what was risk management doing to get that out of the red. Red means they were overly exposed. Now, just that alone, thinking that a risk manager should be in charge of getting an area out of red or advising the head trader or the traders as to how to manage their risk, that's really scary. Hedge funds manage their own risk. They're capable of managing their own risk. They don't have someone telling them how to manage their own risk. And the fact is, if there is a risk manager associated with that hedge fund, it's fake, because the trader himself or herself, before they go on business, they should have already managed their ability to manage risk. Trading is all about managing risk. And what do I mean by that? I mean by that is that when you place trades on a market, you have to manage your losing trades. Your winning trades are going to win. You don't have to play with them. It's your losing trades that become an issue, and that's what turns red. It's overexposed. That's what red means. And so a risk analyst at an investment bank, it's just those traders should already been taught how to manage their risk. And that's what the problem is. That's what I'm trying to portray in my videos. I'm not saying that investment banks are bad, etc., and hedge funds are good or bad. I'm simply trying to tell you that a hedge fund is capable of managing their risk, because they have, the trader himself or herself has a track record, and they've been able to produce and tweak their trading strategy. The strategy is all about managing risk. Okay, anyone could make a bet on the stock market. The fact is that you probably have a 50-50 chance of winning or losing. And so those losing trades is what you are actually managing. Of course, before you enter the trade, you have a calculation in your head how much money you're willing to lose before you have to close that trade. Now, I'm not here to talk about trading, but I do make videos on Bitcoin and stuff like that. But the investment bank traders, they recruit them from, I'm not going to say Ivy League because they're not all Ivy League, but the majority are from Ivy League. They recruit them when they're finished college. They're not graduate students. They're not Ph.D. students. They're young in their 20s, and they start them off as a junior trader. From there, they bump them up to become a trader after, I don't know how many years it is. It could be 3 years. It could be 5 years. I don't think it's 5 years. I think it's like 3 years. Because a lot of students who do really well on test taking, they learn really fast. But those students, they don't have creativeness or the entrepreneur type of brain. Students who do really well on test taking have a huge short-term memory. The students that are entrepreneurs, they probably don't do well with test taking, but they are able to analyze and make whatever they're doing better. That's their mindset. And so think of, let's say, Cornelius Vanderbilt. He was the world's wealthiest man at that time, even today. Nothing has come close. And what he did was, he was taking a steam paddle boat down the river. I don't know what river it was. It could be the Mississippi, whatever. But he was very disgusted that there was no casino, there was no real good food, and there was no entertainment on all the boats. So he bought an old boat and he put a casino, entertainment, a band, playing the banjo probably, and as well as good food. Well, he put all the other boats out of business. And that's how he became wealthy. He wasn't super wealthy at that time, but then he's seen the next wave, which was the railroad in the 1800s, early 1800s. Actually mid 1800s. And so that's how that family became so wealthy. Now today we have the owner of Tesla, the car manufacturer. Who is this man? That man is a person that looks at a situation and analyzes it, tears it apart in his head and makes it better. Okay, the technology may be already there. He's not the scientist, but he's the one that's able to put the puzzle together. and visualize it in his head. Okay? That's what a hedge fund manager is. A hedge fund manager is a person that went off on their own. They somehow got capital, whether it was marrying a rich woman or a rich man, or someone or in the family having a lot of money, and they started trading their capital. However they they found an investor. They were able to raise capital, so they had charisma. But that's who that person is. They're capable on all different levels. Secondly, they also have to continue to tweak their risk management approach because the markets do change. As we know, I talk about a market cycle of 7 to 10 years. It just depends. And those traders know that you have to know how to trade in all those different markets. You have the trading sideways market, the volatile market. There's markets that you enter and no matter what you do, you're losing. That's a very bad type of market. And certain hedge funds do really well in those type of markets. Certain don't. Certain hedge funds do really well when the market's collapsing and it's highly volatile. And then others don't, but they're able to manage their losses. So part of creating a portfolio is learning and experimenting on how to put the perfect hedge fund portfolio together. Meaning a fund of funds of funds, which is called a portfolio of hedge funds. The people at the investment bank working on the trading floor, 99% of them, I'm not saying all of you, but you're not going to be allowed to change what you're doing. And that's what the difference is. When you work for yourself, you are able to tweak what you're doing, change it. But when you work for a big company, you're not able to change. The people on top of you are the ones that change. And the question is, are the people on top of you really changing anything? You have to say to yourself, as an investor, if all the investment banks went out of business in 08 and 09, and if it wasn't for the federal government to lend them money, we would have no investment banks left. All right, well, we would have had Goldman Sachs because Warren Buffett invested in Goldman Sachs. And they didn't want to receive a government loan because they would have to change their policies and whatever, their strategies. And of course, Bank of America bought Merrill Lynch. So Goldman Sachs and Merrill Lynch are the only two investment banks that would have been left if it wasn't for the government to lend them money. It wasn't a bailout like the media says. The government got paid back with interest, and those investment banks made a fortune again. Of course, AIG and Bear Stearns did go out of business because they were so overly exposed in those derivatives that connected mortgages. Of course, when the stock market's collapsing, why is it collapsing? It's collapsing because prices have gone up so much in the residential sector that the people stop buying homes, and then the commercial building sector stop building buildings and homes, so they lay everyone off, and so it's a domino effect like what's going to be happening now. I created a video on that, the coming collapse. I'm not here to scare you. I'm not selling any books. I mean, I have 2 books on hedge fund selection, but my second book is not published yet, so don't worry about it. It's the first one, but it's very technical and you probably won't understand it. So to make a long story short, that's the difference between an investment bank trader and a hedge fund trader. I'm not putting you guys and girls down at the investment banks. You guys are very smart. You're very lucky to be on a trading floor as I was. You either have to know someone, or you are recruited by the Ivy League school, or daddy has put millions of dollars into the company, or your uncle is someone as on the trading floor, or it could be the attorney for the acquisitions group, whatever it is, but you're very lucky to be there. And it's a great start in your career, so I'm not downing you. I'm simply trying to explain to an investor why hedge funds and funds of funds are so different compared to the investment bank trading desk. Now, the investment bank, of course, as we know what they are, they do multiple different specializations. Some of them do hedge fund administration. Merrill Lynch actually just sold theirs. But they do mergers and acquisitions, they do IPOs, and many other types of specializations. That's why they're called an investment bank. Whereas an investment company, which is a hedge fund, they only specialize in one particular area, and that's trading. Now, of course, yes, you have the top 10, which are 30 billion and excess, and they, of course, are hiring traders to trade now because they need to reduce their exposure to one person, and that's where it actually becomes really tricky, because they're repeating what the investment bank trading floors are doing. Again, recruiting from Ivy League schools. Honestly, they shouldn't even be looking at your resume. They should just give you the opportunity to trade and possibly prove yourself, because there's been a number of studies. It has nothing to do with your IQ. It has nothing to do with what university you went to. It has nothing to do what your major was. You don't need to take courses on finance to become a successful trader. Believe it or not, 100 years ago, the most successful traders there were, you were born like that. And there's a certain quality that a trader actually has. And that's something that they are born with. And I can't tell you everything I know, because that's my hedge and secret, but it has to do with a certain type of personality. And I have mentioned that type of personality. Think of Tesla, the owner of the car company. Think of Cornelius Vanderbilt. Think of all these famous, successful people in our time period, just 200 years. And I've, of course, always been the type to watch these biographies on them, because I view success not as how wealthy you are, but what you're capable of improving. And that's the difference between an investment bank trading floor and a hedge fund. The hedge funds improve what they are able to do because it's only one person at that company. The hedge fund manager is the owner of the company and also the trader. And those are the hedge funds that you should be investing in, not the big ones. After 100 million, about 350 million, that's the end. You don't invest in anything bigger than that. Of course, you have to analyze their returns to see if they can still manage their capital. But for the majority, you're going to have watered down returns. You're not going to get that 80% return, that 50% return. It's very rare when you have that kind of capital to continue to produce. And so that's why you should be looking for the younger people out there. I'm not here to sell you a trading strategy or to start a hedge fund. So I'm not trying to, promote myself. The only thing I am trying to promote is to start my own funds of funds, but I'm not talking about that here. I'm simply trying to open up your mind as an investor and to understand where the hedge fund industry is going. That's why they're able to grow so much now in this past decade. The past 10 years for the hedge funds have become incredible because of their returns, the fact that they didn't go bankrupt during 08 and 09 like the investment banks did. The future, so now that I explained to you where the future is going, so the capital is being poured into hedge funds. You have investment banks now investing in hedge funds and hedge fund portfolios, such as the funds of funds, etc. So the funds of funds business, actually in the past 4 years, is really growing. So as investors, you should be looking not to invest directly into hedge funds, but to invest directly into funds of funds. The investment bank idea of putting your capital and forgetting about it and not worrying about it doesn't exist anymore. And you should have already known that when they all went out of business. All the investment banks went out of business. Of course, I told you why. There's some of them are still alive. Some of them are still in business. And of course, so that now you know where the capital is being basically focused on. Those of you who hate hedge funds, you're just watching the media, and the media is just regurgitating stuff to make you watch the program. But the actual truth is that there's nothing scary about a hedge fund. Yes, there was 2 or 3 in the world that was cheating, such as in Midtown Manhattan, the Indian company, and also one of the biggest hedge funds out there. One of his traders was cheating. But you have to say to yourself, yeah, it's wrong to cheat and to get information about a particular company, but it happens all the time. And for example, the reason why I'm making this video now is because I've met a CEO of an investment company over the weekend. And I asked him how his weekend was, and he said he just got fired. So by me knowing that he got fired, I could have short the stock on that investment company. Did I do it? No, I didn't. I respected him, I respected the company, and I respected the fact that I'm not a cheater. So I did ask that person a number of questions, as I always do with everyone I meet. I didn't get to ask him how he got started, like I normally ask, but I did want to ask him, what is the future of investment banks? So like in the 70s, savings and loans went out of business or they were bought out. And then in the 80s and 90s, you had the investment banks form, and then they merged together to become gigantic companies. Of course, when they merged together and they got that big, that's where they became, that they could fail. And their returns were no longer that quality. A true investor wants to have a personal relationship with the company that they're investing in. For example, in Switzerland, there's many boutique investment companies, or I should say money managers, such as there's a beautiful I can't say the name on YouTube, but the people in that little area, in that town, let's say in Zurich, they will invest their money and allow that bank to manage their capital. And they trust that company because they know the person there has been there for many years. And so another thing that changed at the investment bank is that after the 1980s, people were no longer having careers at one company. So a lot of people would retire working for the same company that they started with. That was also a major indication of what's happening and where the quality went. There was no quality anymore. So when you work for the same company for 10 years, 20 years, you're putting your heart into it. And you're putting your heart into everything you're doing at work as if it's your own company. But when you're going to get fired, and according to the book of occupational titles, it's a blue book that's about 4 inches big. The average time period that people work in an investment bank is about 2.5 years to 5 years. 5 years is actually a lot. That person probably doesn't want to leave, but 2.5 years is about average. Now, it could be that there's a lot of changes that happen at the bank, and the company really doesn't they don't care about their employees. Or it could be that that person goes and finds a job to make more money. So what happened was after the 1980s, companies have been recruiting from other companies to try to find talent. Again, that whole concept should tell you that investment banks are gone, basically. That's the end. Because if they actually have to beg someone else at another company to find creativeness, and then that person comes there, and then what are they actually doing? There's no creativeness. It's the hedge funds are the ones that are creative because they own the company, they're the manager, they're the owner, and it's up to them to make that company work. Just like the owner of Tesla. If it wasn't for him, that company would never have been started, including all the other companies that he's doing. So when JP Morgan was at the company, it was innovative. It was him putting all the pieces to the puzzle together to make it what it is. And when he died, management took over, and that's it. Once management takes over and you're gone as the owner of the company, the managers are just just managing the day-to-day responsibility. That's it. For example, my friend's father died. I'm not going to tell you who this is, but it's someone who I work with and who was a great mentor in my life. That's why I have a Ph.D. in finance today, is because of him. He gave me the first opportunity to work at the investment bank on the trading floor for the chief financial office. His father died, and when his father died, his brother took over as the CEO of the company. This is a huge, wealthy family. And so the company that the father established, his grandfather also had that company, and the father, and I think it was a second or third generation. But my friend's father opened up a company producing something in a different way, and it was a better quality, and it was more efficient and cheaper. So think of, let's say, the Times Magazine, the New York, Architectural Digest magazine. That company that was producing that revamped how they made those beautiful pictures in those books. The magazine. So when the father died, the brother took over, and unfortunately, the brother did not have the ability to be innovative like the dad did, or my friend. My friend should have been the manager, the CEO of the company. The brother sells a shipping company, a big shipping company that starts with a D. I'm not going to tell you the name. Why would the brother sell a shipping company when we still need shipping, whereas the digital printing company in America, people were now buying iPads, and they were looking at everything on the computer or the iPad. So they were no longer going to be buying magazines in the next decade. So again, the father's gone, the one that's innovative, and the company goes to pot. So then they have to actually go public because they're losing their grip on the company. They eventually did lose their grip. And so that tells you after one generation, basically, that's it, it's gone, the company. And so now management is taking over, and yeah, the brother's probably still the CEO, but what is he actually doing? There's no innovation. They're buying other companies like Warren Buffett did. Warren Buffett bought Berkshire Hathaway that was failing. But with that company, he was able to leverage his portfolio to buy other companies out there. And of course, when you have dozens of companies, eventually one of them or two of them or three of them are going to do really well. So that's what happens when the CEO, the owner of the company is no longer there. And so that's what happened in the investment banking world. Today, the future of investment banking and that whole industry, where is it going? Well, we have a lot of websites now that are like startups. So if you want to start your own business, you could actually put a profile on there and raise capital for it. Let's say you want to do a pizzeria, or I don't know, like some kind of app, whatever it is. Well, the average person now has the ability to invest capital and possibly make something. Whereas before the 1980s, before the 1970s, you had to know someone at the bank to find possibilities to make money. So you had to know a banker, maybe your next door neighbor if you were very wealthy, and you were smoothing him to get information out of him to find out a new possibility or the direction or a new idea. And that's how hard it was for people to actually come up with new investments. Whereas today, because we have those websites now, the startup website, or I don't know the names of them, but there's many out there, the average person that's not a millionaire, that has $100,000 or $50,000 can find ideas that they personally believe in. Because remember, You don't need to be a doctor of finance. You don't need to be to major in finance to understand business. It's we the people that embrace ideas. And so if we like a certain product, well, guess what? Other people are going to like that product. And so that's what's happening now. The investment banks are losing their grip on the control of the markets and on how and where the funds go, the investments go. Because the average person is not going to the investment bank anymore. Secondly, wealthy people who have more than $1 million to become a client at an investment bank, they shouldn't be going to investment banks. They should be investing in funds of funds. That's a portfolio of hedge funds. That's what I'm a doctor of. And so I know where the industry is going. So I asked the CEO of the investment bank, what is the future of banking? And he said, it's the merger between technology companies and investment banks. So either investment banks that have the capital, that could raise the capital to buy out the technology companies, which that's how it should be. However, the technology companies, they're making so much money that they could afford to buy out the investment banks. And that's really bad, because then that is an official monopoly. Because the technology companies, they have free advertising that they could put out campaigns about anything. And it's really scary that still there's a controlling mechanism in our society that we want to control where everything is. And so as an investor, don't put your money at an investment bank. Of course, if you have a company that you want to go public, yeah, you need an investment bank because you need the funds and the legal team and the all that stuff for the mergers, acquisitions, the IPOs, etc. It's important to go with a big company because they have a lot of big clients. So what they do is when they do an IPO, they send it out to their best clients, meaning the billionaires, and they give them a discount. And then they take that product and they give it to the millionaires, and there's no discount. So it's amazing how when you're very wealthy, you always get great deals at your fingertips. So that's the future of investment banking. You have the merger between technology and investment banks. And as we speak, technology companies are trying to get into the banking industry. Meaning to offer payment systems, to exchange money easily. It's an incredible change that's happening. And I'm living, and you are living during that time. Because when I was born, oh my God, I'm like 45 years old, so that's old. When I was born in mid-1970s, I was so young, I didn't know, but when I was little, my aunts and uncles would give me money. And my parents would take me to the savings and loans bank, and I would have a paper book, and I would write down how much was in there, and how much they would stamp it with their stamp, and that's called the savings and loans. And I always asked my parents, where did that go? Of course, I know the history, so that was 30-year period, maybe it was even longer. But you also had a lot of families owning banks back then and making wealth for their family. And so now, again, that's happening again. You have hedge funds that are making wealth for families and for one particular family, let's say. And people are taking the control back, no longer letting someone else predict how they're going to make money, but they're grabbing it back and they're making decisions, such as those websites I told you about for business ideas. You are seeing a number of people that are very interested in not working for someone else, by taking the control back into their own hands and finding those businesses that they like. No longer just letting an investment bank manage your capital. They all went out of business. You would have been broke if it wasn't for the federal government to stand in and lend them money. And so that's where things are changing now. And so Of course, you're going to see the investment banks merge with technology companies. Who's going to buy out who is the question. That's basically the direction that our future is going. And so as an investor, you need to take your capital and take it into your own hands and manage it. Because when you manage it, it's getting managed. Not someone at an investment bank that's only there 2.5 years, right? You really want a 20-year-old in their mid-20s trading your capital? That's disgusting. It's better to invest your capital in the hedge fund industry with people that have a track record. My funds of funds portfolio, the minimum hedge fund in there is 5 years. I do have one that's 4 years, but that person has proven themselves after 3 years. And the 4th year, which was last year, really proved themselves. They did over 100% return. It was 2 small companies. And the largest companies did in their 50, 60%. But it's interesting, even the large companies that have $500 million, $350 million, and they're still able to produce. And so that's what you should be focusing on. Always think about a new idea, always be innovative, and always focus on what you have to do. Never be afraid. And for those people working for investment banks, I'm not here to put you down. You're not allowed to change the investment strategy. You have to follow what the company wants. And another issue is that what I see is that, okay, so I'm a doctor of finance, so I had to create my own investment strategy. And I had to prove it, so I traded options. Now, I had the time and the ability to do that. But most people are not going to get a Ph.D. in finance because they're already making a lot of money at the investment bank. They probably have already 7-8 years work experience. So are they going to leave to go to school? No. And so they get into this cycle of following everyone else. And so they're following everyone else. And that's also a big problem because as who I am, of course I have to promote myself. Remember, this is my channel. Following other people is the problem. So people who are like Tesla, the owner of Tesla, not the actual scientist, well, actually the scientist as well, they look at a situation and they improve upon that situation. And so that's an entrepreneur. And that's what's changing now. You're seeing a lot of those people out there that want to improve things. And that's just how it is in life. There's a cycle where we're all forced to go work for someone else. That was pretty much the 70s, 80s, and 90s and 2010 period. And remember, at the turn of the century of the 1900s, you had a lot of innovative people from Europe come over and start companies, whether it was making suits or making shoes like my ancestors. Whatever it is, that's all coming back. So I want to thank you so much for watching. Please remember to subscribe to my channel. Share my channel with at least 5 people. Do thumbs up so other people can watch this channel. And please remember to send me messages to the live chat so that I can make future videos just for you.